Welcome to my channel, your ultimate destination for mastering finance and business management. Whether you're looking to grow your wealth, build your business, or sharpen your skills, we've got you covered with practical tips, expert insights, and actionable strategies. Let's embark on the journey to success together. Index funds versus ETFs. Don't choose the wrong one. Are you ready? Welcome to our channel, where we simplify complex investing concepts to help you secure your financial future. In today's video, we're diving into two of the most common investment products, index funds and ETFs. But what makes them different? And more importantly, how do you know which one is right for you? What you'll learn today. By the end of this video, you'll understand how both of these investment vehicles work, their unique features, and how to choose between them based on your financial goals. We'll break down both index funds and ETFs in depth, compare them, and help you make a decision that aligns with your investment strategy. What are index funds? Let's start with index funds. Simply put, an index fund is a type of mutual fund that seeks to track the performance of a market index, such as the S&P 500, Nasdaq 100, or Dow Jones Industrial Average. These funds hold the same stocks as the index it's tracking, in the same proportion. This passive management approach allows for long-term growth with minimal fees. Index funds are passively managed, meaning that the fund manager isn't actively selecting stocks, they're just buying all the stocks in the index. This keeps costs down. Historically, index funds have offered solid, consistent returns over time. What are ETFs? Now, let's look at ETFs, or exchange-traded funds. ETFs are similar to index funds in that they also track a market index. However, the key difference is that ETFs trade on an exchange like individual stocks. ETFs trade throughout the day, which gives investors more flexibility in terms of timing their investments. ETFs tend to have lower costs than actively managed mutual funds. Plus, they're more tax efficient due to their structure. Key differences between index funds and ETFs. Let's now compare the key differences between index funds and ETFs. Index funds can only be bought and sold at the end of the trading day, while ETFs can be bought and sold throughout the day like individual stocks. While index funds generally have low fees, ETFs often have even low fees. But keep in mind, you might incur transaction fees if you buy or sell frequently. Another major difference is tax efficiency. ETFs are typically more tax efficient due to their structure, especially for investors in taxable accounts. Which is right for you? So, which is right for you? It depends on your investment goals and strategy. Index funds are great for long-term investors who want a simple, set-it-and-forget-it approach. If you prefer flexibility, tax efficiency, and the ability to trade throughout the day, ETFs might be the right choice for you. Myths and misconceptions. Let's now bust some common myths surrounding index funds and ETFs. ETFs are always better than index funds. While ETFs offer flexibility and tax efficiency, index funds are perfect for long-term, hands-off investors. Risks and considerations. When it comes to choosing between index funds and ETFs, it's important to consider the risks involved in both options. While both index funds and ETFs are relatively low risk compared to individual stocks, there are still risks, like market fluctuations and liquidity concerns. ETFs may be slightly riskier in terms of short-term trading, as their price can fluctuate throughout the day. Tax advantages of ETFs. One of the key advantages of ETFs is their tax efficiency, which can be a game changer for taxable accounts. ETFs use a mechanism known as in-kind transfers, which helps avoid triggering capital gains taxes when stocks are bought or sold. Understanding your risk tolerance. Understanding your risk tolerance is key to deciding between index funds and ETFs. Let's break it down. If you're someone who prefers stability and a long-term, passive approach, index funds are often the better option for you. How to invest in index funds and ETFs. Now that we understand the differences, let's look at how you can start investing in index funds and ETFs. To invest in an index fund, you'll typically go through a broker or a mutual fund company. You can set up an automatic investment plan, allowing you to consistently contribute over time. For ETFs, you'll need a brokerage account where you can buy and sell them, just like individual stocks. Long-term versus short-term investment strategies. One final thing to consider is your investment horizon, whether you're investing for the long term or short term. Index funds are great for long-term investors who want stability and gradual growth. If you're planning to invest for 10 years or more, they're a solid choice. If you're more of a short-term investor who wants more flexibility and quicker access to your investment, ETFs may align better with your strategy. How to minimize risks in both investments. Both index funds and ETFs are relatively low-cost investments, but they still carry some risks. Let's talk about how to minimize them. One key strategy is diversification. By spreading your investments across multiple sectors or regions, you can reduce your overall risk. You can also minimize risk by balancing your portfolio with both stock and bond index funds or ETFs, depending on your goals and risk tolerance. To wrap things up, both index funds and ETFs are powerful tools for building wealth. The right choice for you depends on your investment goals, risk tolerance, and how involved you want to be with your investments. Thank you for watching Saprik Your Finance. If you found this video helpful, don't forget to like, share, and subscribe. Hit the bell icon so you never miss our latest insights on finance and business management.